Back in the mid-2010s, if you walked around any major tech campus, you were guaranteed to see a very specific uniform. At its peak, the shoe brand Allbirds reached a $4 billion valuation by becoming the unofficial footwear of Silicon Valley. Their breakout hit was the Wool Runner. The pitch was simple. Instead of relying on petroleum-based plastics, they engineered a comfortable, lightweight sneaker using natural merino wool. That initial online success pushed the company to expand outward. They embarked on an aggressive strategy to open physical retail spaces across the United States to capture foot traffic and build brand loyalty. Sustaining a multi-billion-dollar apparel business requires mastering a complex physical supply chain. You have to source raw agricultural materials, manufacture them overseas, ship them globally, and maintain expensive inventories in those local retail stores. Every part of the company's identity was built around producing, moving, and selling sustainable physical goods. But by 2022, the retail model started to crack. Consumer footwear trends shifted away from the minimalist wool look, and the cost to acquire new customers online began to climb. This chart illustrates the severity of the financial collapse. Between 2022 and 2025, overall sales plummeted nearly 50%. Falling from $298 million down to $152 million. The contraction was brutal. By early 2026, Allbirds was forced to close all of its full-priced retail stores in the US. The stock collapsed below $3 a share, and the total market cap shrank to a tiny $21 million. Then came a mid-April press release. The company announced it had sold off its brand and footwear intellectual property to a licensing firm for $39 million. They were abandoning shoes entirely to become an artificial intelligence compute infrastructure company. They rebranded as NewBird AI. The market's reaction was immediate. Shares exploded, shooting up over 700% to briefly top $17. Why would Wall Street traders pour money into a struggling shoe manufacturer simply because they typed AI into an investor presentation? Look at the hardware required for their radically new operational goal. NewBird AI plans to become a provider of high-performance, low-latency graphics processing units, or GPUs. These are the highly specialized chips that train and run massive artificial intelligence models. Operating server farms requires deep expertise in data center cooling, power allocation, and network latency. It is a completely different universe from sourcing sheep's wool and managing retail store leases. The pitch relies on what the company calls structural demand. AI developers are racing to build massive software models, and they need so much computing power that existing spot markets and cloud providers simply cannot fulfill the orders reliably. The financial lure driving this shift is significant. NVIDIA, the primary manufacturer of these GPUs, has ballooned into the most valuable corporation on Earth, with a market cap approaching $5 trillion. The infrastructure layer is highly lucrative. To bridge this gap, NewBird AI negotiated an agreement to raise $50 million in funding. They intend to use that capital specifically to buy up scarce GPU hardware and rent access to it through long-term lease arrangements. The potential revenue from supplying AI hardware is so immense that the company decided to chase it, regardless of their own total lack of experience in the sector. But this sequence of events is not a new phenomenon. When a publicly traded company's core business fails, Wall Street has a predictable historical playbook for manufacturing a sudden burst of investor attention. Go back to 2017. Another physical goods company, Long Island Iced Tea, was struggling to make a profit selling bottled beverages. Right at the peak of the Bitcoin boom, they released a bizarre statement. They announced they were changing their name to Long Blockchain Corp. And abandoning iced tea to focus entirely on cryptocurrency. This split-screen chart compares the market's reaction. Long Blockchain stock jumped 400% simply by attaching to the hype cycle. A decade later, NewBird AI traced the exact same vertical pattern. These hype pivots exploit predictable investor mania rather than demonstrating actual technological capability. The Long Blockchain story has a very specific ending. The SEC eventually delisted the company's shares because they failed to file basic financial documents. The agency even charged 3 individuals with insider trading related to the announcement. That historical precedent casts a shadow over the long-term operational viability of NewBird AI. You end up with a fractured financial market. Retail day traders ride the initial momentum to manufacture the 700% stock spike, while institutional investors stay away because they clearly recognize the operational instability. When a company completely discards its founding mission to abruptly chase a hyper-complex, unrelated trend, they permanently damage their foundational trust with the market. Swapping wool shoes for digital servers overnight is a desperate final act to keep a sinking ship afloat.